A very good afternoon to all the participants. I am C I am CMA Bhavna Yadav from Tax Research Department. I welcome you all to our webinar today on the topic Capital Gain under Income Tax Act 2025. Our guest facilitator for the session is Nilay Baran Som sir, who has generously agreed to share his expertise with us. Sir has joined the Income Tax Department in the year 1990. He has worked in various capacities in the department during his tenure in assessment charges, TDS, International Taxation Division, and in the training sector. He worked on deputation to the Department of Taxes, Government of Botswana from 2002 to 2005. He contributed to the Taxpayer Information Series Booklet 44 published by CBDT on royalty and fees for technical services along with Shri Sanjay Kumar sir in the year 2012. He has also contributed in developing materials for taxpayer services for non-resident. Sir has several articles to his credit which were published in the departmental e-magazine Taxalog. He has been posted as training faculty in the Direct Taxes Regional Training Institute, Kolkata. He has been invited as guest faculty to NADT Nagpur and Regional Institute at Chennai, Lucknow, Bangalore. He has undergone several training of trainer program run by DOPT and also by Civil Services College, Singapore. He participated in the seminar on exchange of information conducted by OECD Paris at the OECD Multilateral Tax Center, Yangzhou City, Chennai. Sir has retired from his services on 31st January from the post of Commissioner of Income Tax, Departmental Representative, ITAT Chennai. Let us take advantage of this opportunity to grow and learn together. Over to you, sir.
Good afternoon. Am I audible, participants?
Yes, sir. You are audible and visible.
Okay. Thank you for the lengthy introduction, and I hope I'll be able to live up to your expectation and expectation of the participants. It's a Friday afternoon, and the participants, they have taken up their busy schedule to attend this webinar. And the topic is provisions of capital gains under Income Tax Act 2025. Now, Income Tax 2025 is a new incarnation of the Income Tax Act 1961. It is the more simplified and more rationalized version, more user-friendly version, which will be in vogue in the coming years, starting from 1st April 2026. That means tax year 26-27. Before that, let us just focus our attention to the words capital gains. As you know, capital gains is the fourth head of income. Now, there are 5 heads of income, and capital gains is a standalone or a very distinctive head, in the sense that in your accountancy classes or also in taxation classes and literature, you have been associated with 2 terms, revenue receipt and capital receipts, and revenue transactions, capital transactions. Generally, it is the revenue receipts that are taxable. Capital receipts generally are not taxable, but there are situations or there are provisions in the Act. It was there in the Income Tax Act, Indian Income Tax Act 1922. It was there in the Income Tax Act 1961, and so also in the new Income Tax Act 2025, that some of the capital receipts are taxable in the hands of the recipients, in the hands of the assessees. So we will discuss what are the provisions of capital gains under Income Tax Act 2025. Now, as you know, this Income Tax Act 2025 is something new to all of us, to you participants, to me as a trainer also. Now, when we try to learn a new thing, the best approach is to take a blank leaf, take it, I mean, as a blank new leaf, and not to bother about what has gone. Okay, so it is one approach is not to bother, to forsake the old, lock, stock, and barrel and start with the new leaf. That is one approach. But in this field, Income Tax Act 2025, I think that it is better if we take a comparative view, because Income Tax Act 2025 is more a continuation and consolidation of Income Tax Act 1961. What has happened is, in 1961, several sections were scattered throughout the statute, and the languages were very not very user friendly. There were long list of provisos, explanations, and all. So the Income Tax Act, from the drafting part, it has tried to make it more user friendly. It has tried to consolidate the provisions at one place, and also tried to do away with certain practices like alphanumerical sections, 80A, 80IA, all these things now has given rise to only numerical sections. So, because as professionals, you are having in your memory, in your collective memory, the provisions that you have already learned and practiced. So, in this presentation, what I will do, I will time and again dovetail between the old act and the new act, so that you can get yourself acquainted, and at the same time, you can use the old act as a good memory to help you proceed with the new act. So, as I said, we are concerned with provisions of capital gains. That means capital receipts which are taxable by virtue of specific provisions of the statute. Okay. Now, the first slide, I call it a curtain raiser slide. First, I will just run through the dates of ITA 2025. Now, if you look at the third bullet, capital gains in the new act, that means ITA 2025, it is sections 67 to 91. Okay. In the old Act 1961, Income Tax Act 1961, it started from section 45, isn't it? But now it is section 67 to 91. And it is an online presentation, so I can't see you basically. Or it is better if you sometimes reply to the queries, or reply, so whatever I'm telling, if you sometimes respond, it will be easier for me. Accordingly, I can manipulate, or I can manage my pace of presentation. Now, basic ingredient, although capital gains is captured in section 67 to 91 in the new act, there are certain basic ingredients of capital gains that was there in the 1961 Act as also in the new Act. What are the basic ingredients? For capital gains to be triggered, there must be a capital asset. That capital asset must change hands. It must undergo a process called transfer. It should be transferred from one assessee to another, and there should be the economic impact. What is the economic impact? In this way of transfer, the transferor should either gain or suffer a loss in terms of the value of the asset. So, basic ingredients of capital gains, as we know, capital asset in the old Act 1961, it was defined in section 214. Transfer, it was defined in section 247. And resulting in capital gains and loss, it was defined in section 45 of the Income Tax Act, primarily. And 45 had a number of subsections. So in our presentation, capital gains actually is a very long chapter. It's a very long chapter. So I will take portions of capital gain. It is not possible to cover each and every section of capital gains within the span of 2 hours. So, but I will, my aim will be to acquaint you with the fundamentals, which as a professional, as a practicing professional, will be of help to you. Okay. So now I will run a navigator with respect to ITA 61. I repeat, although capital gains sections are sections 67 to 91 in the new Act, but capital gains starts with ideas of capital asset and transfer. Capital asset and transfer are not defined in section 67 to 91. They are defined in the definition section, that is section 2 of the Act. So that is why I will run a navigator, and while I will run a navigator, some of the sections I will discuss along with you. Now, this. Please see the screen. Is the screen visible to all of you? Is the screen visible to all of you? Yes or no? I'm not getting any response. Is the screen visible to all of you?
Yes, sir.
Okay. How many participants have logged in?
As of now, 133.
130. So sometimes if they respond, then I will be able to see, I mean, I'll be able to gauge how much participative it is going on, and with what pace I should go, because there are a lot of slides. I have a lot of things to share. Okay.
Yes, sir.
So you can just write in your chat box so that they can have a look. Okay. That is my expectation from the participants. Participants are largely professionals and students also.
Yes, sir.
Now, as I said, it is 23rd July. I mean, there is a typing mistake. It should be 2024. The Honorable Finance Minister Nirmala Sitharaman ji, in her budget speech, made an announcement that the new act is going to come. The new draft bill, ITB 2025 Income Tax Bill, was tabled on Parliament on 13th of February 2025. And it was sent to the Select Committee of Parliament, Joint Parliamentary Committee. It was headed by Jay Panda of Biju Janata Dal, most probably. And revised ITB was tabled and passed following certain recommendations of some changes vetted by the committee on 11th of August 2025, and it received the presidential assent on 21st of August 2025. And it will come into force from the financial year beginning on 1/4/2026. Now, one very important thing is, in the new Income Tax Act 2025, we have done away with the concept of assessment year and previous year. Now, the financial year is called the tax year. So 26-27 tax year is the benchmark year, is a starting year from where the new act will start. Now, here is the navigator. navigator, there are 3 slides navigator which shows the link between the new act and the old act. And also it's not possible to show each and every section under capital gains, that is 67 to 91. But I have taken relevant sections which are more frequently used by all of us, professionals, students, etc. For example, definition of capital asset, it is in section 214. In the new act, it is under section 225. Definition of transfer 247 vis-a-vis 2C109. Short-term asset, short-term capital gain, and there are the flip side is long-term capital asset and long-term capital gain. Now, before we progress further, capital asset. Capital asset by definition is property of every kind, isn't it? Property of every kind, tangible, intangible, whether it is used for business, whether it is used for profession or not. So that is the definition, and there is, although there is change in number of the section, there is no change in the definition as such. If we just have a look at the definition of capital asset, section 222. Let me go through. Capital asset means, so it is an exhaustive definition, not an inclusive definition. Capital asset means property of any kind held by an assessee, whether or not connected with his business or profession. That is the primary test of a capital asset. Second, any because it requires an explanation, that is why I am expanding. The B clause is any securities held by a foreign institutional investor or held by an investment fund specified in section 224(10)(a, which has invested in such securities as per the regulations made under the Securities and Exchange Board of India 1992. In the Indian capital market, there are F2s or foreign institutional investors. They are permitted to play around, and these investors generally they make frequent transactions. Whenever they see the economy is performing well, they will invest. Whenever they see that the economy is not performing that well, they will withdraw that capital. So there are a lot of transactions by this F2 or FII. What happens is, in earlier years, assessing officers sometimes used to take a position that this is your business income and not capital gains. Okay, so naturally capital gains has a lesser rate of tax vis-a-vis the business income. Now, to attract foreign direct investment, and for the larger picture of the economy, what the government has done, they have made as a part of capital asset by definition. So the assessing officers will not be able to treat these transactions anytime as business transactions. These are all capital gain, resulting capital gain or capital loss. Third is unit-linked insurance policy, ULIP. ULIP is more or less like a mutual fund, but initially ULIP was having some advantage like the life insurance policies, that the maturity sums are not taxable. So there was no level playing field with the mutual funds. That is why ULIP has been put at par with mutual funds. So these are the capital gains, but it does not include, there are so many lists. For example, personal effects, they are not part of capital asset like that. Next is definition of transfer, section 247. 247 transfer, the corresponding section, you see the increase in number of sections, it is subsection 109, 209. There is no change in the languages, there is no change in the content as such. So Transfer includes sale, exchange, extinguishment of right. All these things are there. Enjoyment of movable property by TP Act 1953. All the ingredients that are there in the 2025 Act also. Now, short-term capital asset and short-term capital gain. Now, for the whatever has been amended, I think by Finance Number Act 24 and Finance Act 25, corresponding to the Income Tax Act 1961, has been retained in the Act. So there is a sense of continuity between the old Act and the new Act. So we will see what is the, we can just discuss what is the time limit. For example, a capital asset will generally be termed as a short-term capital asset if its period of holding does not exceed 24 months. But for certain assets like equity shares of a company, Indian company, then equity-oriented mutual funds and unit-linked policies, for them, these are the period of holding will be regarded as 12 months. So once the holder holds the asset for 12 months and after that he disposes of that asset, that capital asset, the resulting capital gain will be long-term capital gain. Incidentally, it may be said that long-term capital gain is taxed at a lesser rate rather than the short-term capital gain. So this portion I would like to put a bit emphasis. Let me just go through section 2 to subsection 102. Let me just go through. Let me go through 201 because long-term capital asset and long-term capital gain has been defined negatively under the Act. For example, the definition of long-term capital asset is long-term capital asset is a capital asset which is not a short-term capital asset. That means one need to know what is the short-term capital asset. Now, short-term capital asset means a capital asset held by an assessee for not more than 24 months immediately preceding the date of transfer. So far, so good. Now comes the exceptions. In respect of the following capital assets, number 1, security listed in recognized stock exchange in India. In any of the recognized stock exchange, if securities are listed. Second is unit of the Unit Trust of India. Third is units of equity-oriented fund. Fund means mutual fund. So from this, it appears that units of equity-oriented fund have been given an exception and also zero coupon bonds. So in respect of the following assets, 4 assets. One is security listed in recognized stock exchange in India, unit of the Unit Trust of India, units of equity-oriented fund or zero coupon bonds. The period of holding, instead of 24 months, it will be 12 months. So another point important to note is it is only equity oriented fund that is given a preferential treatment. Debt funds, they are either whether they are short term or long term, they do not have any advantage so far as tax rate is concerned in the new Act, and as also in the finance immediately to Finance Acts of 1961. There are certain transactions like, for example, capital asset on distribution of dissolution of HUF, or if I gift my house to my son, that is a gift. Okay, so this is not to be treated. So if I transfer my house to my son, so there will be some transfer of ownership. The title will change, but it will not amount in transfer. That means it will not be a part of capital gain. If I transfer a house to a non-relative for a consideration, so that will be capital gain. But if I make a gift to my near and dear ones, or even a stranger, but with a proper recital, so that gift or will or inheritance, they are not regarded as transfer. Now the charging section of capital gain 45, that means 45, the corresponding new section is 67. That means what are the ingredients? The ingredients again are, there has to be a capital asset and there has to be a transfer of that capital asset. And transfer is as defined in section 209 of the Income Tax Act 1961. So this is my first navigator slide. Now, if we remember, because all of us are, quite familiar with section 48, which was the computational provision for capital gains. The corresponding provision, as you see in the navigator, is section 72. Now, so far as computation is concerned, from our school arithmetic days, we can consider that any gain means sale price minus cost price. In case of capital gain, technically it is called full value of consideration less cost of acquisition. Now, these two sections, cost of acquisition and cost of improvement, and also cost with reference to certain modes of acquisition, these are used to be defined in discussed in section 55 and 49. The corresponding sections are 90 and 73. Sorry. I'm not going to discuss 90 and 73 right now. There are separate slides for them. Now, capital gain for depreciable assets. The corresponding section is 74. And what is special in depreciable assets? In depreciable assets, generally, when a depreciable asset is sold, generally there is no capital gain as such, because that capital asset falls in a block of assets. When some asset is sold, the block with written down value will change only, nothing else. But sometimes it may happen that some SSC, whether an individual or a partnership firm or a LLP or a company, is selling a block, lock, stock and barrel. So if it is so, the block ceases to exist. In that case, of course, there will be capital gain of that depreciable block. Sometimes it may so happen that there is a block, there are 5 assets in that block, but you are selling one asset, and it may exceed the cost of all the WDV. So generally in two situations, there may be capital gain from depreciable assets for an SSC who is running a business. Now, so far as cost is concerned, while calculating capital gain for depreciable assets, you have to take the WDV also, because they have already got that deduction. Now, cost of acquisition for inheritance, gift, etc. I'll discuss section 73 separately. Capital gains for depreciable assets is defined in section 50, and cost of acquisition is discussed in section 50A. I stand corrected that depreciable assets will be subject to capital gains similar to non-depreciable assets is covered in section 50, and the corresponding section is section 74. And cost of acquisition is defined in section 75. Here you see that cost of acquisition, general cost of acquisition is defined in section 73 of the 25 Act. But cost of acquisition for depreciable assets is separately defined in section 75 of the Act. Now, there is a concept of slump sale that mostly happen with companies in practice, but any other business entity can undertake a slump sale. What happens is slump sale was discussed in section 50B of the Income Tax Act. The corresponding section is 77. So let us try to revise what is there in slump sale. In slump sale, what happens is an assessee is not selling its business at all. It's selling one of its undertaking. For example, let us say that Tata Group. Tata Group is selling its Tanishq division, the diamond division, okay, or whatever, or Titan division, like that. So if any company is selling an undertaking which is owned by it, that undertaking will have a lot of assets. It may have land, it may have building, it will have machinery, it will have stock in trade, like that. So, but in a sale transaction with some other party, it may not be possible to assign separate values for all the assets because it is a business deal. They are getting a lump sum consideration for transfer of this undertaking to some other interested business party. So that is defined in section 77 of the Income Tax Act 2025. What happens is, how capital gain is to be computed in case of slump sale. The formula is you have to get the fair market value of all the assets less the liabilities, and from that you will deduct the book value of the assets less liabilities. And if any asset is revalued for the purpose of this sale, so when you are determining the cost of acquisition, when you are trying to fix the cost of acquisition, that revaluation of the asset has to be ignored. So the formula for capital gain here is FMV of the assets less liabilities minus book value of the asset less liabilities. Now, there is one section which all of us know because of our practical association with this transaction of sale, transaction of purchase of immovable properties. All of us in some point of time has either involved ourselves in sale of some property or got involved with sale of property with any of our near and dear ones or our friend, like that. So one section is very famous, that is basically a deeming fiction of the Act. I think it was introduced by the Finance Act 2006 or 2005, like that. It says that if an immovable property being land, building, or land and building, that means it can be a standalone land, it can be a standalone building, or it is a building situated on a land appertinent thereto. So if such assets are sold, the immovable property has to be transferred through the process of registration. In registration, the Stamp Value Authority determines the price. What is the price on which the stamp duty has to be paid by the purchaser? Now, often it is seen that the stamp duty value exceeds the deed value. Historically, it was there because particularly in olden times, there used to be lot of cash transactions in transaction of immovable properties. So the deed will show one price which would be paid in through bank draft or check, and some underhand dealings was there. To stop that practice, the government made a law that the stamp duty value will be the deemed value of the transfer of the assets if it is more than the deed value. So that 50C section has transformed itself into section 78 of the Act. We'll have a detailed slide on this section. Next slide also I will discuss later on. Now, deduction provisions. Once you determine the capital gain, there are certain deduction provisions available to reduce the incidence of taxation. This I can say section 54 and its brothers and sisters or siblings. That is as per the 1961 Act. So section 54 is property used for residence. If property used for residence is sold and a new property for residence is purchased, there is relief from the capital gains. The corresponding section is 82. There was some section 54B, which is associated with deduction from investment in agricultural property. So if some agricultural land which was used by the assessee or his parents for the past 2 financial years, and now it is sold, and the sale proceeds is invested in purchased or acquisition of another agricultural property, so that will resulting capital gain will be reduced by that investment. See, the corresponding section is 83. 54D, the corresponding section, I will come to that, is 85. 54F, it is another popular section. Section 54 is when is section 54 triggered? If somebody sells a residential property and purchases another residential property, then he will get a benefit of section 54. But if the asset is other than residential property, somebody is selling a land, vacant piece of land, or somebody is disposing of jewelry or some valuable article like painting, and with the sale proceeds, he is keen to purchase a house, then the resulting deduction section in the 61 Act, it was not section 54, which is from sale of house property, but it will be from sale of other property and investment in residential house. The corresponding section was 54F. In the new Act ITA 25, where there is no alphanumerical section, the resulting section will be 86. So 82 will be there, and 84 will be there, and 86 will be there to replace 54, 54B, and 54F respectively. There was another section where somebody is selling a whatever property it is. It may be a house property, it may be a land, it may be any depreciable asset, it may be some paintings, it may be some valuable apparels. That means whatever is falling on definition of capital asset, it is sold, and the resulting proceeds are invested in, say, for example, bonds. What are the bonds? Some specified bonds like National Rural Electrification Bond or National Highway Bond. If these investments are made within 6 months from the date of transfer, then the assessee will get some benefit of deduction up to some amount of money specified in the section. The section 54 EC deduction on investment of bonds have also been translated into the new Act in the form of section 85. Now, tax on short-term capital gain and long-term capital gain are as per section 196, 197 and 198, which we will discuss separately. So far, Navigator is complete. will come, and in the next slides, we are referring to the new section. But at the same time, while speaking, I will narrate to the old section also, so it is easier for you to catch up, easier for you to relate from the old act to the new act. So far as competition is concerned, it is embedded in our head that competition section is section 48. In the new act, we will not speak about section 48, but we will speak about section 72. What is the competition scheme? The sale price is called full value of consideration, less expenditure in connection with transfer, maybe brokerage, maybe any fees paid like that. Then cost of acquisition and cost of improvement. Previously, it was, particularly in case of long-term capital gain, it was indexed cost of acquisition and indexed cost of improvement. For the past 1 or 2 years, after 23rd July 2024, that means Finance Act 24 onwards, basically the concept of indexed cost has been done away with some exception. The indexation benefit is only for calculation purpose. That is also for two types of assessees, individual and AHF assessee. So I will come to that later on. So just to start with the competition scheme, what is the scheme? Full value of consideration, less expenditure in connection with transfer, less cost of acquisition, less cost of improvement. That will give you the taxable capital gain, which is again subject to certain deductions under section 82, 83, etc. in the new act. Now, so far as expenditure in connection with transfer, it was there in the old act and also in the new act that in case of shares in a listed company, list shares or mutual fund, security transaction tax, which is payable by virtue of another statute, that is Security Transaction Tax Act, STT, that is not a deductible expense. Now, cost of acquisition, the corresponding section in the old act was, I think, 49. In the new act, it is section 90 of the Income Tax Act 2025. So I'm referring to the relevant subsections. Section 90, subsection 3, it prescribes that as the definition of capital asset goes like this, that it is property of every kind. So it can be tangible as well as intangible. It can be associated with business or it can be not associated with business also. So intangible assets like goodwill, trademark, etc. What is their cost of acquisition? Section 90, subsection 3 specifies that. If somebody is selling his business, now when he's selling the business, all the due diligence activities that are concerned, and there is some valuation done of the business. Now there may be intangible assets like goodwill, trademark, etc. So whenever he's selling it for the first time, all these intangibles like goodwill, like trademark, like brand value, all of them has been built by him. It is he who has painstakingly built up the value of the business. So these are self-generated assets. For self-generated assets, the value is taken as nil. But if he's selling it for the second time, it will be and the second, whoever has purchased for the second time, sales of that business after certain period of time, the value for the goodwill or trademark, the cost of acquisition will be the actual cost paid. 90 subsection 5 deals with rights shares or bonus shares. I have got a separate slide for them. I'll show you. Now, if As you know, when the section 48 was there, there was concept of indexation, and indexation, the initial benchmark year or the base year was 1981, 1481. Later on, it was fixed to 14/2001. So if what is the formula for computation of capital gain? It is full value of consideration less cost of acquisition less cost of improvement. Now, if somebody acquires the asset before 1/4/2001, then its cost of acquisition will be its actual cost of acquisition or fair market value as on 1/4/2001, because most of the time the capital assets, they appreciate in price. Okay, except for certain assets like motor car and all, they which depreciate depreciable assets. Other assets, they appreciate in time, appreciate with time. So it is either cost of acquisition or fair market value as on 1/4/2001, which has to be taken as cost of acquisition. And if the asset comes free to the assessee by way of gift, inheritance, etc., then cost of acquisition to the previous owner or its fair market value as on 1/4/2001 will be the cost of acquisition, which will be deemed. And the asset to be transferred, if it is land, building, or a combination of land and building, then cost of acquisition will not exceed the stamp duty value as on 1/4/2001. If such other asset means if it is land and building which has been acquired before 1/4/2001, so its cost of acquisition will not exceed the stamp duty value. I mean, these are all deeming provisions. Now, cost in respect of certain modes of acquisition, in the Income Tax Act 1961, the corresponding provision was section 55. In section 73, one feature of the new act is it is very user friendly or reader friendly, I would like to say, and there are a lot of tables, lot of schedules which help people to get the content of the act in a more easier way. So in section 55, cost in respect of certain modes of acquisition, it was in narrative form. Now, but now in this new act, it is in a tabular form. It has certain serials, certain serial numbers and certain descriptions. I'm taking for the sake of example some of them. Serial 1, asset received through gift or will or by succession, inheritance. In those cases, the cost of acquisition will be cost to the previous owner. And if the previous owner also gets it through gift or will, then it will be cost to the earlier previous owner. Cost of share of an amalgamated company minus cost of share of the amalgamated company. Sweat equity shares. Sweat equity shares, as you know, sometimes the companies award shares to its starred employees who have increased the value of the company by their intelligence, by their talent, etc. So it is more than ESOP. So sweat equity shares, if they are allotted to an employee, and if after some time he sells those shares, so what will be the cost of acquisition? Cost of acquisition is when the share was allotted, it's for example, the value of the share as per market is 100 rupees. Now the share was allotted to the starred employee at 20 rupees. So 100 minus 20, that means 80 rupees he has is included as is perquisite at the time of its allotment. But when he is selling it, if he's selling it, for example, 300 rupees, 300 minus 100, which was the market price of that share at that point of time, will be the deemed cost of acquisition. Now, serial 18, it may be important to you as a professional. There was some scheme, IDS, Income Declaration Scheme 2016. The old timers will be knowing that there were similar scheme before also. For example, VDIS 96 was there. Now it is Income Declaration Scheme. So in Income Declaration Scheme, there was some provision for declaration of capital assets also. Now, if those declared capital assets, which has already suffered tax, are now transferred, if they are transferred, the FMV of the asset for the purpose of the scheme that has been disclosed by the SEC will be the cost of acquisition. Now, cost of improvement for goodwill or other intangible assets will be taken as nil, particularly for the self-acquired goodwill or other intangible assets. Now, if asset is acquired before 1/4/2001 by the SEC or the previous owner, all capital expenditure on or after that date will have to be taken. So past date cannot be taken because we are taking the fair market value of the asset or its actual cost as the cost of acquisition. So far as cost of improvement is concerned, cost of improvement always means some capital expenditure. For example, if it is a house, if you are painting the house, it will go on revenue account and it is not a capital expenditure. But if you are, for example, remodeling the house or extending the house, those will be cost of improvement. Or the house is there, but initially there was no wall around it. So you have built the wall or you have built a staircase. Those will be cost of improvement. So any capital expenditure done by the SEC or the previous owner on or after the benchmark date of 1/4/2001 will be cost of improvement. In any other cases, again, capital expenditure incurred by the SEC or the previous owner. In cases where, for example, SEC passes on to asset passes on through inheritance, gift, or will, etc. Slum cell I have discussed before. This is for the purpose of recapitulation. Slum cell, the relevant section is 77 of ITA 2025. Now, slum cell has been defined into section in the definitions chapter, section 2, subsection 103. What is it? It is a business transferred of one or more undertaking. It may be transferred of one undertaking or it may be more than our undertaking for a lump sum consideration where individual value of assets are not given. Individual value of assets are not given without specific values assigned to individual assets and liabilities. And there is a very, remarkable thing here. Here, the benchmark period of holding is 36 months. What is meant by that? Generally speaking, what is the benchmark period for to distinguish between short-term capital asset and long-term capital asset? The duration is 24 months. If an asset is held by the SEC for 24 or not exceeding 24 months, it will be short-term capital asset. But in case of 4 assets like equity shares in a company, unit of a liquidity firm, unit of equity-oriented fund, this unit trust of India, units of unit trust of India, like that, all those will be for them the period of holding will be 12 months to be regarded as short-term capital asset. But for slum cell, there has not been any amendment. It has been kept as such from the olden years. So the period of holding is 36 months. So if it is more than 36 months, If somebody sells more than 36 months, it will be subject to long-term capital gain. So people can accordingly plan their, make a tax planning like that. If, for example, why? Because long-term capital gains, the taxation rate is less. So if they want to make a slump sale, they can make it after 3 years of existence of the assets as such. So far as computational provision is concerned, as you know, it is full value of consideration less cost of acquisition less cost of improvement. For some sale, FMV of the capital assets as on the date of transfer is the full value of consideration. How the FMV is determined? There was certain subordinate rule number 11QA in the old act. The new rule has not come up yet, but I think it will follow the same pattern. So far as cost of acquisition is improvement is concerned, it is net worth of the undertaking. It is defined in section 77 how it is to be calculated, and it has to be certified by an accountant. Accountant here, of course, means a chartered accountant. But that is a different story. I think cost accountants, you are also equally competent to make this certification. But anyway, whatever has been decided by the government, we have to stick by that. Now, as I said, 50C, the corresponding section is 78. So I'm not reading it, just have a look at the slide. So if the stamp duty value is more than the consideration received as per deed, the stamp duty value will be taken as fair market value. And sometimes it happens that the sale agreement has done before the actual sale is registered. So the stamp duty value on the date of agreement may also be taken as FMV subject to certain conditions like that. It has to be whatever payment has been made, it has to be made through check or some electronic mode like that. Okay. And there is some tolerance limit of 10%. If the, for example, you are selling the house for 50 lakhs, you are selling the house for 50 lakhs and the stamp duty value is say 53 lakhs. No, it is within 10% of the tolerance limit. Why? Because if it is 50 lakhs is your sale price, then 10% of that is 5 lakhs. So either way, if it is 50 lakhs and the stamp duty value is more than 55 lakhs, then only stamp duty value will partake the figure of sale price. Otherwise, it is a tolerance limit of 10%. It will be treated as such as 50 lakhs. I hope I am able to clear this. Now, here the stamp duty value was taken as fair market. Stamp duty value was taken as fair market value in case of immovable property, section 78 of the new act. Now, there is a corresponding provision, section 79 of ITA 2025, which was corresponding to section 50D of the Income Tax Act 1961. If shares of unlisted company are sold, if shares are in listed companies are sold, the rule is simple. If the period of holding is more than 12 months, it will be long-term capital gain and the tax rate will be less. And if it is within 12 months, it will be short-term capital gain only. But here the consideration is received for shares of an unlisted company and consideration is less than the fair market value determined in prescribed manner. Because in unlisted companies, what happens is many times it is clever tax planning or tax evasion. Sometimes it is planned by astute planners. That much I can say. So if the department thinks that the consideration that is being shown by that transaction of capital gain is less than the fair market value of the asset, fair market value of the shares, and for that also there was a corresponding rule how to determine the fair market value of the share. So that consideration will be deemed as full value of consideration. That means you are selling the shares for a price of 10 lakhs, but its market value is say 17 lakhs. So 17 lakhs will be taken as the full value of consideration. Now, Section 78, so far as practicing accountants are concerned, are very difficult. I mean, very common, because you will have your clients who is facing this 50C, Arts 1250C issue, and which you will face in the form of Section 78 in the new Act. What is the impact on the transporter? What is the event? Event is a land, building, or a combination of land and building is sold, and the sale price is less than the stamp duty value. Impact on the transporter is the stamp duty value will be deemed as the sale price. On the flip side, the transferee, for him, the relevant section in 1961 Act was Section 56(2), 56(2)(13) or something like that. The corresponding flip side is Section 92(2)(m)(2). What is the flip side? You are purchasing for, say, purchasing the property for 50 lakhs, but its stamp duty value is 57 lakhs. So this 7 lakhs will be taken as a deemed gift or income under the head income from other sources in the hands of the receiver. So it is a double whammy. This, the seller is also suffering the stamp duty tax, and the purchaser is also suffering the same taxation. It's not a double taxation in a way, because the incidence is same. I mean, the difference is the incidence, but the impact is on two different assesses. So there is not there is no actually double taxation this way. Now, both the Arts 12 Section 50C and Section 56 had some relief clause. What is a relief clause? If there is a difference between the sale price and the stamp duty value, and the assessing officer wants to impose the stamp duty value as the deemed sale consideration, and the condition is the purchaser did not make any appeal to reduce the stamp duty value, has paid the value. In that circumstances, the assessee can request the assessing officer to send it to valuation cell for a proper valuation of the property, which he thinks will be proper, because many times what happens is stamp duty value takes the value of the nearby property, but some properties they have may have their old typical problems, like it is more older property, or the access road may not be that good. All these factors can be instrumental in inserting a belief on the assessee that actually his stamp duty value should not be the deemed consideration. So in that event, he can request the AO to send it for valuation under Section 78(2), and the purchaser also, although he had not appealed against the imposition of the stamp duty at that time, but now he can come up in appeal before that imposition, citing certain factors that he thinks that stamp duty value should not be used in his case. So after it is given to the valuation officer, the ball becomes in the court of the DVO. DVO sends a valuation report, and the valuation report, it may sometimes support the stamp duty value. It may be sometimes below the stamp duty value. But sometimes if it exceeds the stamp duty value, that value will not be taken by the assessing officer. He will take the stamp duty value only. But if it is less than the stamp duty value, the lesser part will be taken as the full value of consideration, where it has been sent for reference and the DPO has submitted a report. Reference to valuation in the Income Tax Act, the assessing officer can send to valuation suo motu under old section is 55A, now it is section 91, or old section is 142(2A), now it is 269, that is for the purpose of assessment. Okay. On request of assessee under section 78 or 93 proviso. There is no proviso in the new act on request by the assessee under section 78 or 93. So for that, reference can be sent. Now, since all of you are mostly in Calcutta, there may be participants from outside, neighboring states also. But by and large, I suppose that you are all from West Bengal. So there is an important judicial ruling. The Calcutta High Court, in the case of Sunil Kumar Agarwal versus CIT in the year 2014, it is a reported case 372 ITR 83, had ruled that since the assessing officer is a quasi-judicial authority, even if the assessee doesn't make a request to send it to valuation cell, whenever there is a difference between the stamp duty value and the deed value, and the stamp duty value is more than the deed value, the assessing officer should and shall send the valuation exercise to the DVO. So this is Judicial High Court view. So it is better you become aware of this provision of this citation, and in many of your cases you can use it also as a professional guide to your client. You can advise a client that you can ask the AO that this provision is there. This is Judicial High Court decision. It is binding on you. So please send it to valuation. Even if I have missed it, please send it to valuation. Or the the assessing officers also in that on the same angle, the department should educate the assessing officers about this important judicial ruling. Now, rights shares at a glance. Rights shares are issued to existing shareholders. So what is discussed in this slide is type of asset, some basis or event, what is its cost of acquisition, and what is the period of holding. Not time of holding, it is better, period of holding. Original share is the basis of entitlement to right share. If somebody is holding original share, then only he will get a right share, otherwise no. What is the cost of acquisition? Amount actually paid. Time of holding is from date of allotment of the original share. Now, sometimes what happens is a company makes around announcement for rights entitlement and to the existing shareholders. Sometimes an existing shareholder can renounce that offer in favor of a third person. If he renounces that offer, right entitlement, its cost of acquisition of course is nil, and the period of holding will be from date of offer to date of renouncement. But if he exercises the right and purchases that share, then the cost of acquisition becomes amount actually paid to the company for the rights share, and period of holding starts from the date of allotment to him. Now, in the second row, what happened is rights announcement was there, but some shareholder, he did not accept the rights, but he renounced the rights in favor of a third person. Now the assessee is the renouncee or the third person. So What is his cost of acquisition? He has to pay some price to the renouncer because that is the gain of the renouncer. Renouncer's cost of acquisition is nil, but he has sold his right now for a consideration. So price paid to the consideration plus price paid to the, because he has to obtain the share from the company by virtue of his newly got right. So price paid to the renouncer plus price paid to the company becomes his cost of acquisition. And period of holding is from date of allotment of right, not from date of allotment of original asset. So far as bonus shares are concerned, bonus shares are basically it comes free. Bonus share if allotted after 1/4/2001, the cost of acquisition is nil, and period of holding is from date of allotment of bonus shares, not from date of allotment of original shares. But if bonus shares is allotted before 1/4/2001, in that event, of course, we have to take the fair market value as on 1/4/2001, which is the benchmark year. So here also the period of holding it will be from the date of allotment. The only difference is in the first row, the date of allotment will be after 1/4/2001, and in the second row, the date of allotment is before 1/4/2001. As I said, there are several deductions for capital gains. While discussing the flyer also, I had made certain discussion on them. Let us revise again. Profit on sale of property used for residence. The relevant section is 82. We can navigate it to section 54. Deduction on sale of agricultural land, it is 83. Capital gains on compulsory acquisition of land and building, it is 84. Deduction on investment in certain bonds. Certain bonds means rural electricity bonds and national highway bonds. The corresponding section 85, and deduction for investment in residential houses 86, corresponding to 54. Now section 82, 83 and 86, they are basically for individual and HUF assessees, because those deductions were basically given to boost the real estate sector and to help people build their homes or get their homes. That is the purpose. All these sections have a pattern. You sell the property, you get some money, and you have to invest in some property, be it a new residential house in case of section 82 and section 86, or be it a piece of agricultural land under section 83. So if you can invest it immediately before filing of your return of income, fine. You will make the investment and show that in your return of income. But sometimes it may not be, purchase in immovable property or construction of immovable property, that may not be so easy. So, it will take years to purchase. It may take years to construct a property in particular. So there are certain liberal timeline given to the assessees to invest in the new property. In case of outright purchase, it is 2 years from the date of transfer. In case of construction, it is 3 years. Either way, 2 years here, down below, or it may be previously also. In previous time also, whatever. So if the assessee decides to invest in the property within a period of 2 years, that is allowed by the Act, then he will claim the deduction in the return of income, but he has not invested. So the prescription of the Act was invest the money in some account of selected banks like capital gain account scheme. So that is the pattern. And there is bar of selling once the property is acquired, new asset is acquired, there is a bar in transfer of that property for a particular time of years, within 3 years or something like that. If you transfer that property, the whatever deduction you have got earlier will have to be basically, it will become your income. So there are, those I'm not going to the details because our time is limited, but that is the pattern of all these sectors, all these sections, all these deductions. What is the pattern? First of all, there is some liberal time given for construction or investment or outright purchase. Second, if all such events, all such activities are not completed before file of income, before filing of return of income, you will invest the money in capital gain account scheme. And if the new asset is transferred within some time given in the act, so either you will have to pay more tax, or you will have to pay the more tax from the new capital gain, and whatever benefit you have got earlier, that 54 deduction, that will be withdrawn, and that income will be treated as income of the year in which the violation has taken place. So basically that is the crux of these deductions. Now there are rules for set aside and set off and carry forward also. So if we recapitulate what we have done, first of all, we have said what is capital gain. Capital gain, it stands distinctive from other sources of income. It is capital receipt, but it is taxable by virtue of operation of the Income Tax Act, be it the 1961 Act or the 2025 Act. Second, we have seen the navigating sections. We have been navigating the two acts, one act to another. There is a transition. Basically, there is no alphanumerical section in the new act, but there is not much new content also. Particularly whatever amendments have been done even in the Finance Number 2 Act 2024 and Finance Act 25, that has also been captured in the new Income Tax Act 2025. What is the difference? The difference is more or less in renumbering the sections, number one. Number two, in presenting the sections. For example, in the 1961 Act, it was mostly in narrative form, but here, along with narrative form, there are tables also. For example, in section 73, corresponding to section 55 of the Income Tax Act 1961, there is a tabular representation. And we have also seen in detail, particularly the practical implications which impact your clients or even you, like section 78, how it works, both on the transferor and the transferee in the form of section 92. Now, we'll go to the rules of set off and carry forward. Within source, STCGB loss to be set off only against STCG gain if computed in the similar manner. So, STCG loss from short-term capital loss from, say, equity-oriented fund, that is taxed at a special rate of 20%. But short-term capital gain is from listed shares is taxed at a special rate of 20%. So, for example, you have undergone a loss in one share. In the case of one listed company's share, say you have undergone a loss of 10,000 rupees, and in another listed company share, you have gained 30,000. So 30,000 and 10,000, you can allowed to set off, and the resulting 20,000 will be subject to tax at the rate of 20%. But if you have suffered loss from debt fund, suffered loss in debt fund, but there is a profit on equity fund, they are not computed in the same manner. You will not be able to make intra-source adjustment. Again, STCG loss can be set off again against LTCG gain also. It is not written here, but STCG loss can be set off against LTCG gain also. But LTCG loss to be set off only against LTCG gain if computed in the similar manner. Similarly, LTCG loss from, say, listed or mutual funds or listed shares, that can only be adjusted against LTCG gain. So these are somewhat complicated provisions that has basically enacted from 24 Finance Act number 24, Finance Act 25, and they have been retained in the new act also. So far as inter-source is concerned, if income under any other head is lost, it may be adjusted against any other head, including capital gains. So if there is loss from, say, income from other sources, it may be adjusted against any other head, including capital gains. But there are certain terms and conditions apply. For example, business loss cannot be adjusted with salary loss from loss under the head salary. Profit under the head salary, income under the head salary cannot be adjusted with business loss, and house property loss can be adjusted to the extent of rupees 2 lakhs only. All these terms and conditions are there. Second bullet is very important. Loss under the head capital gains. Loss under the head capital gains cannot be set off with other heads. So if some assessee suffers loss under the head capital gains, that the only option left for him is to carry it forward to the next year and to be adjusted with any possible capital gain, any possible long-term capital gain. Otherwise, it will have its natural death. Now, capital gains tax rate in the new act. Okay. The corresponding section is section 196 of the Income Tax Act 2025. I am not going to examples or calculations because that, as professionals, you will be able to guide your clients on your own. I am going to basically the conceptual structure, how it is there reflected in the new act. Mostly it is a case of continuation, but there are certain changes here and there. So there are 4 types of asset. Equity share in a company, unit of equity oriented fund, unit means mutual fund unit of equity oriented fund, unit of business trust where STT is paid. For them, the rate of tax is 20% if it is short-term capital gain. Now, what is a unit of equity oriented fund? If in the fund the investment in equities is 65% or more, then it will be called a equity oriented fund. If it is less than that, then it will be a debt fund. So in case of assets like equity share in a company, unit of equity oriented fund, or unit of business trust where STT is paid, the rate of tax is 20%. For other assets, if somebody is selling his, say, jewelry, he has purchased a jewelry, the wife of the assessee has purchased some jewelry. Now she wants to, she is also an assessee, she is selling that. She didn't like that. So within a period of, say, 10 months of purchasing. So it will be subject to normal tax rate, not rate of tax of 20%. Unlisted shares, again, that will be subject to tax as per slab rate. So if the assessee happens to belong to the higher income slab, he will be affected by the higher income slab and he will not get the preferential rate of 20%. Now there are so many other riders also. If the preferential rate is 20% is to be availed. In case of assets in row number 1, from the short-term capital gain, no chapter 6A deduction. Chapter 8 is corresponding to chapter 6A of the Erstwhile Act. No chapter 6 deduction will be allowed on the short-term capital gain. So if his income is, say, 10 lakhs from short-term capital gain and 15 lakhs from 15 lakhs from income from other sources. Okay, so his total income is 25, and if he has deducted, made a donation of, say, 10 lakhs, 10 lakhs in the Prime Minister's Relief Fund. So that deduction will be made only from income from other sources, and no deduction will be made from the income under the short-term capital gains, which is subject to a special rate of tax. But resident, individual, or HF to get slab benefit. Let me give an example. For example, somebody has sold a house and house or any other property, and the gain is short-term capital gain is 7 lakhs. But his income from other sources, being in interest income, is 1 lakh. So this 1 lakh, and what, let us say that for that year the slab rate was, say, 4 lakhs. Slab rate is 4 lakhs. So out of 4 lakhs, he is having income from other sources 1 lakh. So had he not, if he had not any income from capital gains, he won't have to pay any tax. Now he has been subject to capital gains tax, that also on a income of 7 lakhs. So here what is the quantum of unexhausted slab? If the slab is 4 lakhs, his income from other sources is 1 lakh. So 3 lakhs is the available surplus from the slab that he can adjust with his income from capital gain. So his taxable capital gain will be 7 lakhs minus 3 lakhs. Okay. Third is, but reduced rate is not available if transaction is undertaken in IFSC and consideration is payable in foreign country. It may so happen that foreign players, the IFSC is already, I think, there in Gandhinagar, and these are for economic reasons. They invest, sometimes they sell the shares also, but for them this benefit is not given, provided if transaction is undertaken in IFSC and consideration is payable in foreign country. See, here again, there are 3 rows. The sections involved are section 197 and section 190. in the Income Tax Act 1961, the corresponding sections was section 112 and 112A. Now, for the purpose of understanding, I have made it in a 3 rows. What is the first row? The first row comprises equity share in a company, unit of equity oriented fund, unit of business trust where STT is paid. If the income tax on capital gains will be subject to tax rate of 12.5% on the capital gains exceeding rupees 1,25,000. Okay. So out of these shares, if there is capital gains and your capital gain is rupees 3 lakhs. So 3 lakhs minus 1,25,000, that means 2,75,000 will be subject to 12.5%. Here there is, I want to convey this to you, particularly those who are practicing income tax. If you go to section, 190, text of section 198, or if you go to the present act, that means Income Tax Act 1961, section 112A, I believe. Let me just have a look. Section 112A. It is section 112A in the 1961 Act. If you go through the Act, text of the Act, the standard deduction of 1,25,000 is available to all the assessees, irrespective of the status of the assessee, whether it is a company, whether it is a cooperative society, whether it is individual or HUL. This 1,25,000 should be available. But I have been told by some of the, 1 or 2 practitioners that the system does not give this benefit to any assessee other than resident individual and HUL. I don't know whether you have similar experience in your practice. So you can have a look at this issue, and if necessary, you can flag it, because from the reading of the plain act, nowhere it is written that this benefit of 1,25,000 will be available only to resident individual and HUL. Okay. So again, this LTCG under section 198 corresponding to section 112A of the older act, no chapter 6A deduction used to be available for this. Similarly here, no chapter 8 deduction is available on the capital gains portion. Resident individual or HUF, likewise in the case of short-term capital gain, will give the slab benefit if the other source income, if the income other than capital gain is less than the minimum slab. This portion has to be corrected. Third is reduced rate is not applicable if transaction is undertaken in IFSC and consideration is payable in foreign country. So you will not get many examples, real life examples on this, but it is there in the statute, and particularly this will be applicable for foreign assessees. Second is if the asset is land, building, or both. The corresponding section is 197 and the rate is 12.5%. The first 2 rows are applicable here also. Now, if the asset is acquired before 23rd July 2024, because that year budget, the 24 budget had introduced certain changes, particularly indexation has basically been done away with, and there was a lot of hue and cry when the bill was introduced. After that, government has given certain leeway, certain benefit to the assessee, which has been again carried in the section 196 in the form of section 197 of the new act. What is the benefit? If the asset, there is a asset. What is the asset? Land, building, or both. It is sold, for example, 40 lakhs rupees. It was purchased, say, in the year 2021, or say it was purchased in the year 2017 for 10 lakhs rupees. Now the capital gain will be 40 minus 10. That means 30 lakhs rupees. And the tax rate will be, it will be subject to tax at the rate of 12.5%. So 30 lakhs into 12.5%, it will be certain figure, say figure X. Now, what is the benefit given? Because the asset, when the asset was purchased, that person was award of the indexation. Now he will be given the benefit of indexation, and he will calculate what is the tax, 40 lakhs minus 10 lakhs into indexed cost. So whatever is there, what is the tax at the rate of 12.5%? Let it be Y. So X minus Y will not have to be paid. So whatever tax payment, that will be restricted to Y. So just think about this. This is the benefit given, and assessees and you as practitioners can guide the assessees to get this benefit. All other assets will be subject to 12.5%. So in the new act, as also in the Finance Act 25, rates of capital gains tax has been rationalized very much. So basically, for capital gains, now there is only one rate, that is 12.5% of the capital gain. Now, certain contentious issues that as practitioners you may be dealing with. Claims of exemption. Basically, it is very common. Many a time there is a lot of fight between the assessees and the department. Assessees are claiming that it is an agricultural land, so it is not a capital asset. So it should not be subject to taxation. And the department says, no, you are not able to prove that some agricultural operation was carried out on it. So basically, here it is basically a factual issue. Claims of exemption, so far as agricultural land is concerned, it is a factual issue. There are case laws on either side. So basically, if you get such a case, you have to research yourself how you can give benefit to your client. Or if you think that no, it is a case in which we cannot establish any sort of agricultural income or use of the land for agricultural purposes, there is no evidence, it is better to pay the tax, you can advise your client accordingly. Compulsory acquisition issues under various acts, I will devote a separate slide for that. Business income vis-a-vis capital gains. So many times, particularly in share transactions and mutual fund transactions, many times there was certain, assessing officers used to consider certain income as whether it is business income or capital gain. So sometimes they used to tax it at capital gain and sometimes show it as business income. That happens with assessees also. They used to show income according to their benefit, sometimes as capital gains or sometimes as business income. So in the Finance Act 2026, there has been one circular issued by the government. I will give you the circular. It is not included in the presentation. I will give it separately. I think, let me just tell it. I can tell you the circular number. Just hold on. Most probably it is CBDT circular number 6 of 2017. Okay. I'll include it in my presentation. I'll give it to your coordinator. So now things are stabilized. The crux of the circular is if the assessee is showing it as his investment portfolio continuously, the department will not disturb that position. If the assessee is showing it as a trading portfolio, the department will generally not disturb that position. Okay. Taxation of joint development agreement, it is also a contentious issue, and capital gains in case of non-residents, it is also a contentious issue. So next slides we will be discussing those issues. Compulsory acquisition. In case of compulsory acquisition of lands, etc., compensation or additional compensation received under any law or consideration determined or approved by central government or RBI is taxable under section 67 clause 12 of the new act. It is a replica of the erstwhile section 45(5). But earlier on, what used to happen is one type of asset, urban agricultural land, was exempted under section 1037 subject to certain conditions. What are the conditions? That it was used by the assessee or his parents for 2 years. Okay, so that was the condition given, and similar condition is given now because all the exemptions, there is no section 10 now, it is given in a separate schedule under schedule 3 of the Income Tax Act. So basically, if we go to section 1037, erstwhile 1037, so it has to be situated in the area specified under section applicable to agricultural land. It is an urban agricultural land, and such transfer is by way of compulsory acquisition under any law, or a transfer the consideration for which is determined by approved by central government or RBI. Now, apart from that, there is another type of acquisition under RFCT LARR. This is rehabilitation, fair rehabilitation treatment. Under there is a separate law for this. For that, under that law itself, it is the full name of the act is the Right to Fair Compensation and Transparency in Land Acquisition, Rehabilitation and Resettlement Act, RAFCLRR. This is the act. If compensation is received under this act, so whether it is for agricultural or non-agricultural land, it will be tax-free. It will not be subject to capital gains taxation. In fact, there was a Supreme Court judgment on this also. Now, joint development agreement is a transaction with which many of us are familiar, either in our personal capacity or as a in the capacity as a consultant to your client. What happens is, many times what happens is, we have ancestral properties. There is a land, there is a property. The property is sort of, it is difficult to take care of the property. Now, we take a call and give it to some developer. So there is a tri-party agreement, joint development agreement. The developer will take the land, will build a property on that land, and generally the ratio is 50-50 or it may be 40-60. He will give you certain built up flat along with certain money and rest of the flats he will sell and he will earn profit. So that is the joint development agreement. So there are various case laws and the position of the law is very clear. It is generally taken whenever there is a tri-party agreement and there is some irrevocable transfer deed signed by the original owner, and the land is given to the developer by virtue of a registered power of attorney and by virtue of a registered development agreement giving the right, that means transfer is effective. The moment the JDA, registered JDA is signed, the capital gains is triggering. So the thing is, what agreement has been signed? Agreement is certain promise of property, not even the property, because it will take 2 to 3 years to complete that project. The individual is getting some promise of some finished property or completed flat and some money consideration which may pass now or which may pass in future. So if the joint development property is joint development agreement is signed is 2017 and the house is actually handed over in 2020, in many cases the department I mean, let me give the years a bit back. If the joint development agreement is signed in 2012 and the property is actually built up in 2015, in 2012, since it was the agreement was signed, in many cases the department has taken a position, no, you have to pay the tax in 2012 only. And so far as the language of the act goes, in such cases, the assessors did not get any relief from the tribunals or courts also, because it is as per law. But the problem is particularly very inconvenient to small taxpayers like individuals and HUF. For companies and all, there may not be a much problem. But for individual and HUF, it was there was a lot of hue and cry that we have not got any money out of the deal, but how we will pay the tax. So actually, when Mr. Arun Jaitley was the finance minister, he made an announcement in the budget and that was enacted, and that position is there in the new Income Tax Act 2025 also. Capital gain, although irrespective of the capital gain actually triggers in the year of signing the agreement, capital gain in such cases will be triggered and affected in the year of issuance of completion certificate by the competent authority, whether it is municipality or panchayat or cantonment board or whatever, or development authority or whatever. So for example, the JDA is signed in the year, for example, 2017, and the property is completed in the year 2021, for example, in that event, and the CC is also used issued in the year 2021 by the municipal authority. So the capital gains will be taxable in the year 2021 only. So that there is a big respite to the individual and HUF assessee who will pay the tax when at least he has got some money, when he has got some built property. Okay. And full value of consideration, how is to be considered? It is the stamp duty value of his share in property, share of land, plus whatever promised flats, 4 or 5 flats or 2 flats, whatever he has got, its stamp duty value, plus any money consideration that will be regarded as the full value of consideration in respect of JDA. So JDA taxation, if the assessee is a cooperative society, if the assessee is a company, if the assessee is a firm, it will be one time, and if the assessee is an individual in HUF, it will be much more liberal. The incidence of tax will be at a later part of time. Capital gains for non-residents. So there is a misconception that is available with many practitioners also, that indexation is not to be allowed in the case of non-residents. the case is not so actually. Indexation for any property will not be allowed in the hands of non-residents only when the asset is acquired by the foreign currency. So particularly it is in respect of various shares and debentures and units. Many times non-residents, they purchase it, or maybe government bonds or other bonds that the foreign, non-residents, they may purchase it with foreign currency, and then for that indexation benefit was not allowed. But for assets, now for that matter, indexation benefit is not allowed for all other assets except land, building, or a combination of land and building. So if a non-resident has a property in Calcutta and he is selling it, and the asset was acquired by him before 23rd of July 2024, will he be able to get the benefit of indexation? My answer to this, my take on this is it will depend, because many times the property might have been acquired by him not in foreign currency but from his Indian accounts. So in that event, theoretically, there should not be any problem for getting indexation benefit if the house is transferred. But for non-resident, one thing is very important, that if money is remitted, TDS to be made. Previously, there was one section, section 195, that was a separate dedicated section for deduction of tax at source for the non-residents. For the new Income Tax Act 2025, the relevant section is 393. But here I must draw your attention, particularly those who are practicing, to one important instruction that was given by CBDT, instruction number 2 of 2014. What used to happen is, many a time the department used to insist that tax is to be deducted on the wholesale value. For example, you're selling your property for 40 lakhs. So 195 deduction will have to be made only on the whole 40 lakhs what is to be remitted. The department has come up with this instruction, which is available in the public domain, instruction number 2 of 2014. TDS is to be made only on the gain portion, because corresponding section 195 or whatever section, section 393 in the new act, tax is to be deducted on the income portion, not on the whole portion. Okay. Now, this one is a bit, section 92D read with 99 and section 202 subsection 109H of the Income Tax Act 1961. This basically corresponds to R12 section 911 read section 911 of the Income Tax Act. Okay. Do you remember the Vodafone case? This is basically the Vodafone case. The Vodafone case, because there was no enabling provision, the government ultimately lost in the Supreme Court. But later on in 2012, there was some retrospective amendment given. And what is the impact? Now, what is the law position is, if shares of a foreign company is transacted between two non-residents, but the share, who are transferring share of a foreign company, but share of a foreign company derives its value, underlying value, from an Indian company. So situs of the transfer will be deemed as India. So the income will be deemed to accrue and arise in India. So basically for this section only, there may be one session or half a session. So I'm not going to discuss that, but I'm just flagging this issue before you, that section 911 that was there in the 1961 Act is also there in the new Act in the form of section 92D of the Income Tax Act. So be quite careful about this. If you get any corporate client or corporate, if you are working in some company and there is some transfer of shares of your company by two non-residents, you will be able to say that no, we attended some webinar, this section was spoken of. Let us see what is there in that section. So, good evening. Sorry, I thought there was a phone call from your side only. So now one or two slides I'll just show you repeals and savings, because 1961 Act is going to be wound up, and the new act that is going to come is Income Tax Act 25 from the 1/4/2026. So there is a repeals and savings section 536. Now in section 536(1), there is a clause: if deduction is allowed under repealed act with caveat that such deduction will be included in total income of assessee in the year of violation, such sum to be deemed to be income of the tax year in which such violation is made. So the implication for capital gain is, for example, somebody had taken, say, 54 deduction in the year 2023, okay, or 2024, and he has taken the liberty that he will construct the house within 3 years. In the event of failure, the provision of the act that this deduction will be treated as income of the assessee in the year of violation. So that, but now the act is, paradigm is changing, the act itself is changing. So that by virtue of repeals and savings, this violation will still be taxable in the year of violation according to the relevant provision of the new act. Similar thing happens if some property already transferred, which was barred to be transferred within 3 years of purchase under capital gain, if that is also violated, that violation will be governed by the new taxation provision. So whatever capital gains tax that was, or whatever deduction was availed earlier, will be treated as income in the year of violation after Finance Act 25 comes into existence. So there is a possibility. So no way people can just play with promises and not pay taxes. Let me just, there is no time for discussion, and I did not mean to discuss also, but let me just flagging these cases with you. Let me take the third case, CIT versus Manjula J. Shah. It is Bombay High Court decision. It is very important decision, particularly those who are practicing chartered accountants, because indexation virtually is there for land building or land and building. What happens is, the language of indexation is, indexation, how do you take cost of acquisition into index for the year of transfer divided by index for the year in which the asset, in which the assessee becomes owner of the property. That is the language of the act. So what has to happen is, in case of gift and inheritance, we are taking the, for example, let us take a example. Let us take an example. Assessee has assessee has got the house as a gift from his father in the year 2015. Now he is selling the house in 2022. So what will be the indexation? Indexation will be cost the house was constructed by his father in the year 2010 for 10 lakhs rupees. It was gifted to the son in the year 2015, and now he is selling it in the year 2020. So the formula will be cost to the assessor is nil, but we have to take the cost to the previous owner. That means cost to his father 10 lakhs. 10 lakhs into cost inflation index for the year of sale being year 2022 divided by cost inflation index for the year. Here is the question. The language of the act is in which the assessee became the first owner of the property. Assessee got the property in the year 2015. So that was the department position, and the assessors generally used to do it like this. Cost of acquisition, since we are reverting back to the father, so far as indexation is concerned, in the denominator we will not take cost inflation index for the year 2015 in the year of gift, but we will take the cost inflation index for the year of construction by the father. That means 2010. So it was litigated very much, and the Bombay High Court gave that we have to do some harmonious construction of the statute. Since you are going back to the father, so far as cost is concerned, for indexation alone, you cannot come back to the son. You have to give the indexation benefit, greater indexation benefit to the assessee by taking the index of the previous year, resulting in more indexed cost, a larger indexed cost, resulting in lesser capital gain. CIT versus Balbir Singh Maini. It is a very important case so far as JDA is concerned, Joint Development Agreement. Here it has been said that a JDA, if it is not registered, it doesn't have any effect, and accordingly there will be no capital gain as such. Okay. It is a Supreme Court decision. Please go through the decision. It is a very nice decision, favorable to the assessee. But the next decision, Sheshai Steels Private Limited, that is also a Supreme Court decision, departs to this principle to some extent, telling that if there is enjoyment of property in the form of letting the developer use the property, make advertisements and use the property, then there will be enjoyment of the property and capital gain will be taxable. Capital gain resulting capital will be taxable, particularly if consideration is paid. So these are very two interesting cases. The fourth case is regarding joint ownership of the property. So it is an assessee favorable ruling. Before here the position has been taken that if the new property under section 54F is a joint property, it will not disentitle. If property transferred is joint property, it will not disentitle the assessee from the deduction. So more or less what we have done today, and at the end of my presentation, basically we have traveled what is capital gain. It is capital receipt taxed by virtue of the statute. Now, when it comes to the statute, we are all acquainted in 1961 provisions. Next, we have gone to what is in store for us in the 2025 Act. This being a very long chapter, it is not very possible to go through each and every section, but we have undergone many sections which are very much useful to us so far as practice is concerned. So we have gone through the relevant sections. We have run the navigator so that the sections can be mapped, and we have discussed the contentious issues and also given reference to a few case laws. So that is, I think, some quiz for you. You can just have a look at the presentation. Benefit of indexation is available to which class of asset? I think it is known to all of you by this time. Is sale of personal motor vehicle subject to capital gains tax? Think about it. Can capital loss be adjusted with any other head of income? Think about it. What is the benchmark period for short-term capital asset? The reply is normally it is 24 months. Exceptions, these equity shares and all, for them 12 months, and for slump sale it is 36 months. What is the rate of tax for long-term capital gains on stack of equity shares? Indian company, of course, it is 12.5%. So here I end my presentation. I think it is useful to you. So thank you for the participation. So here I finish.
Hello.
Yes.
So there are few question and answer in Q&A section.
Okay. Let them ask the questions. Any questions, please tell.
Sir, it is in the chat box.
Okay.
There is a Q&A option available
Okay,
at the right hand side.
let me just stop the presentation now. Okay. Can you read it out? I'm not getting any question.
Sir, there is a question. If you scroll down, there is a question from CMA Niranjan Mishra. In
Okay.
the
Okay.
in the sale deed, 4 legal heirs have signed, but the money has been transferred by the buyer to the account of second legal heir. Whether capital gain is taxable in the hands of all four or only two person whose account money has been transferred.
No, please repeat the question again.
So the question is, in the sale deed,
Hmm.
4 legal heirs have signed,
Hmm.
but the money has been transferred by the buyer to the account of 2 legal heirs.
Hmm.
Whether capital gain is taxable in the hands of all four or only two person to whom account money has been transferred.
No, here, what are the parties? The seller is one, no?
4 legal heirs in sale deed.
Four legal heirs. They are the seller. There are four persons, and
Huh.
the property whoever has purchased, he's sending money to the two of them
Uh,
instead of four
yes,
of them.
yes, sir. Yes,
So
sir.
no, transfer is between the owners. Okay, transfer is between the owners of property. So it has to be apportioned irrespective of whoever has got the money. Okay. Otherwise, it will not act. So the sale deed must contain what are the conditions under which the sale is agreed. Sale is arranged. Whether they are having equal shares, whether they are having pro rata shares, whether they are having uh, 2:1 like that. Okay. So if there is share the property they are transferring, if they have equal shares, the sale consideration will be taxable in each of their hands. Okay. So for their own arrangement, they can take the money in their bank accounts of two of them. Later on, they can arrange among themselves, and the others can get the money. But law-wise, it is the full value of consideration that will be taken as in the hands of four of them. Four of them are supposed to voluntarily declare capital gain. That is the thing. That is my position. Any other question? Yes, I'm getting the chat box now. Wait a minute. Wait a minute. So I'm getting only good afternoon messages. So, Vaibhav Gupta. Okay. Apart from that, any other question, Bhavna? Hello? I'm scrolling, but I'm not getting any question right now. Are you there, Madam Bhavna?
Hello.
Hello?
Yes, sir.
I'm getting good afternoon messages only. Any other specific question?
Yes, sir. One more question. An agricultural land is sold,
Hmm.
whether the capital gain arising from such land is set off against the purchase of residential land and house or only residential land.
No, agricultural land. It is an urban agricultural land, no? Because
No,
if it is a rural agricultural land, it will be exempt from capital gain, so there is no capital gain. So please read the question as it comes.
sir, it is not mentioned whether it is a agricultural land or rural
So
agriculture.
let us suppose that since it is not, it is a capital asset, it is an agricultural land which is not an exempt asset. Okay, it is an
Okay.
agricultural land within the municipal limit or so. Okay, it is an urban agricultural land. Next, ask me the question. It is an urban agricultural land has been sold. Then
Whether the capital gain arising from such land is set off against the purchase of residential land and house or only residential land.
no, there are two options available. I am speaking of the. I mean, let me give reference to the existing 61 Act only, because then it will be easier for him to understand. Okay. So if the agricultural land is sold and some agricultural land, the money is invested, net consideration is invested in some agricultural land, he will get deduction under section 54B. That is one option. Okay. Second option is agriculture. He has sold the agricultural land, which is a capital asset, which is not an exempted asset in his case, and he is purchasing a residential house property. In that event, he can apply for deduction under section 54F. So that is also possible. Am I clear?
Yes, sir.
So that is possible.
Okay,
Please
sir.
look for any other question.
Let me see, sir. No, sir.
Done. So actually, this is my first lecture so far as capital gain in the new act is concerned. I thank all of you for listening.
Thank you so much, sir, for such an engaging and insightful presentation.
Thank you, Abna. Thank you for sitting through. So,
Thank you, sir. Have a nice day.
oh, oh.